안녕하세요. 김현석의 월신나우를 사랑해주시는 한경글로벌마켓 애독자 여러분 반갑습니다. 저는 지금 맨하탄의 한복판에 나와 있고요. 요즘 시장이 굉장히 안 좋죠. 특히 금리가 굉장히 높게 치솟으면서 주가를 압박을 하고 있습니다. 왜 도대체 그런 일이 일어났을까요? 그것을 월가의 굉장히 유명한 리서치 펌이죠. 스트레티가스의 제이슨 트레너트 설립자를 만나서 물어보려고 나왔습니다. 그의 인터뷰를 보겠습니다.
First question is bond yields keep rising. Yeah. And what is the most important reasons for this? And do you think it will rise further? And how much will it rise more? And is it a good time to buy bond?
Well, my own opinion is that bond yields are likely to rise further, and I think we had something in the United States or globally, which was quantitative easing, in which central banks were buying a lot of bonds, and I think a lot of people have forgotten that normally investors or lenders require some premium over the level of inflation to lend other people money.
Right.
So the typical spread over inflation is about 200 basis points. So if you believe that inflation is about 3% now, and my own opinion is it may be sticky, it would suggest that you should have a bond yield of about 5%. And so to me, just to the extent to which the Fed and other central banks won't be as aggressive in buying bonds.
Not back to the QE.
No, if you believe that QE is unlikely in the future, it seems to me that the old rules of thumb should apply.
And it may be over the 5% in this year?
It may get up to over 5% in this year, and a lot of that really depends on whether inflation is as sticky as we think it is. I think among our clients, most clients believe that inflation is over or that it's largely been defeated. And I would argue that we're not so convinced that it's been defeated. Gas prices are up quite a bit, and then you've seen very meaningful wage concessions given to labor unions in just the last several months. So there's a chance that inflation remains higher for longer than many investors suspect.
Labor is within the labor union. It's a very small fraction in all of the the population.
So true. Private sector union membership is only about 4.5%, but it does give other labor signals about their bargaining power. And I would also argue that you're at a 3.5% unemployment rate, which is close to full employment. And job openings, according to the JOLTS data, are still meaningfully above where the number of unemployed people are. So all of those things would suggest that labor has some bargaining power now that they haven't had in a long time.
But the people who see the disinflation to continue, they said the housing cost will going down little further, and also the used car price will be negative.
Those will be counteracting forces. And I would particularly say housing is a particularly strong component, it's a large component of inflation, but I would also say that labor is probably the single most important factor in terms of corporate profits. And so I'm of the view that this inflationary period is not over. That what you might what housing might take away from inflation, there are other sources of inflation that might emerge, and you're seeing that today with gasoline prices in the United States, which are up 20% year to date.
That means sometimes in remains of this year, people will gonna surprised or frightened about the resurrections of inflation?
I think at a minimum, I think they may come to the conclusion that the Fed is unlikely to ease anytime soon. And right now, if you look at the Fed funds futures contracts, they're suggesting the Fed might ease 4 times by this time next year.
Yeah.
And I would argue that that's very unlikely without an accident. You know, perhaps a financial accident would
like a banking
like a bank crisis
something.
or private equity or something. That could that could do it. But aside from that, I think it's unlikely.
Okay. There is an argument that the structural era of a high interest rate and high inflation is coming. Do you agree?
I believe that the era of low inflation or low interest rates is over. And that's largely because I think the era...
That's the Bill Dudley said today in the Bloomberg opinion.
Oh, I actually did not see that. But I do think, to the extent to which the era of QE is over, it means that you're going to have more free-floating interest rates, more volatility in interest rates, and I would also suggest that you're going to have higher interest rates, unless inflation plummets from here. So I believe that financial assets have benefited greatly from quantitative easing. Most of the inflation until recently was in financial assets, as opposed to goods and services. And I think right now, last year was probably an indication that that baton is being shifted from financial assets to goods and services.
If something happens, like the sudden recession, something like that, you think Fed will not going back to the QE? Just they lower the interest rate a little bit, that's all?
Yeah, I think that they have to be careful because as we saw with Silicon Valley Bank failure, the Fed actually increased the size of its balance sheet by about $400 billion. But since then, the balance sheet has actually declined further than where it was before Silicon Valley Bank failed. So there may be particular instances in which the Fed might have to inject liquidity into the system. But my own feeling is that unless something structurally changes with inflation, those will be short-lived instances like Silicon Valley Bank.
So different from the QE, right?
Different from QE, which was largely 12 years long. And I think now it's going to be used more sparingly than it had been in the past.
Okay, got it. And the S&P has fallen about 5% from the recent peak. As yield breakout, when and where do you think the short-term bottom of the market will be?
Boy, it's a very difficult question. At a minimum, I think that the risk-reward for the market is not very favorable from here, which is to say that I think the upside for the market is pretty much the highs that we've seen for this year. 4,600, I believe that it'll be the high for this year, so you don't have much on the upside. And I think the downside can be meaningful if you do get a recession. And I think that a recession is not an unlikely scenario. I still think a recession is quite possible, which means that...
Your base scenario is a recession?
We believe a recession, the odds of recession are about 3 and 4 over the next 18 months. Typically, the median decline in earnings during a recession in the US is about 20%. So it may not be as severe this time, but it does suggest that the bottom could be well below 4,000.
Why do you believe a recession is coming?
There's really a couple of things I would point to. The first is that the yield curve is inverted and has remained inverted for a long time. And that's important because it does give you a sense of a second reason, which is banks' willingness to make loans declines when the yield curve is inverted. And generally speaking, tighter lending standards tend to lead to job loss and weaker economic activity. And then the last reason I would say is that corporate profits have been down 3 quarters in a row. Now they're not down a lot, but they've stopped growing. And given some of the issues that we talked about in terms of labor, I think it's going to be hard to get outsized profit gains from here.
But Wall Street analysts today expect the earnings will gonna rebound from now on to the third quarter, fourth quarter, and next year will be boom.
Yeah, it's and again, I'm trying now. That could happen, of course. I think the only way I could see that really happening is with a productivity boom
From the AI.
from AI or supercomputing, which is possible. My own opinion is that the benefits of AI and supercomputing are probably more likely to be seen over the next several years as opposed to next year. And that's why I'm very skeptical in the very optimistic earnings estimates for 2024. Again, if you're starting with full employment, it's really difficult to get a big increase in economic activity or earnings. There's just not much room to go without a productivity enhancement.
You're talking about the AI, and there is a high expectation for the Nvidia.
Yeah.
And do you think Nvidia stock price will continue to rise and lift the Nasdaq entirely? And is this AI boom an AI bubble or not?
It's hard. I would say it's difficult to say at this point because certainly the promise of the technology, it's not difficult to see that it could be very meaningful for corporate profits. As I said before, though, I do think this is not something that's going to be that evident for a number of years. As far as Nvidia is concerned, I certainly wouldn't short that company. By the same token, the company is very expensive. The stock is extremely expensive, and the expectations are extremely high. And so I'm not sure I would be buying it either because I think in a period of higher interest rates, you want to be careful about companies that we call long duration equities, where you are very dependent upon future cash flows to justify the current price. And so I may be missing out, but the stock has moved an awful lot already, and again is trading at very, very high multiples.
How about the other big tech stocks?
Well,
like Apple.
Sure. So the Magnificent, they call them the Magnificent Seven. And here again, I would say that what we're finding is that they have defensive characteristics because they have so much cash and because they generate so much cash. So there again, I think those companies will probably hold up pretty well. Even if there is a recession, they may hold up relatively well because they have a lot of cash, and then they earn money on the cash that they have, which is not something that many companies have been accustomed to. But they have an ability, given how much money they generate, cash flow they generate, to make their own luck in a way by buying back stock or by issuing dividends. Or I'm more worried about the parts of the market where, let's say in the Russell 2000, there are about 40% of the companies in the Russell 2000 that haven't had a profit in the last 12 months. Those companies seem to be particularly vulnerable to higher long-term interest rates.
The S&P has fallen a bit, but it is still trading around 4,400, which is higher than most of the Wall Street strategists' year-end targets. And the PE ratio is also over the 19 times. Why do you think the stock market is still so strong, and despite of a spiking yield and policy rate or something like that?
Yeah, I think it's two things. One is the economy has remained resilient. Certainly consumer spending in the U.S. has remained resilient. And it also say inflation has come down, right? So, and there are expectations that the Fed will ease, as we talked about before. So I think that's why the market is held in there. I think if any one of those assumptions is incorrect, though, the market is vulnerable. And I would say the one that's most vulnerable assumption is the idea that the Fed will ease next year, as we discussed before. I think that at this point it's very unlikely, unless there's an event that happens that would very likely be bad for risky assets, right? So it's hard to imagine an event happening, a good event happening in the short term that would force the Fed to ease. And I think the Fed is going to want to be sure that inflationary expectations are anchored before they start cutting rates.
In some time in this year, the consumptions were gonna be a negative.
I don't know about negative.
There is a lot of student loan repayment or the surplus will gonna used out, something like that.
Yeah, I think the key, and I think what we missed and many other economists missed this year, is that the labor markets have remained very tight. And Americans, generally speaking, are not big savers. So that we found ourselves in a very strange situation where we had a fair amount of savings. Now we're drawing it down, but the spending is somewhat sustainable if you have a job. But if you start losing jobs, that's a whole other story. And I would argue that is probably the key to our view of consumer spending and just the overall economy as well.
There is a growing expectation of a soft landing, and probably one of the reasons for the rising yield and high stock prices. But if the interest rate rise this high, and can the U.S. economy stay strong? And do you think a soft landing is still possible?
Soft landing is possible, but I would say, to be very honest and candid about it, that there are very few examples of a soft landing when the Fed has tightened this aggressively. The only one I can really think of is 1994, where there was a soft landing, but at that point the Fed didn't tighten nearly as much as it has now. And so, in my opinion, what's underpriced in the market is the possibility of a hard landing. To me, that is more likely than the consensus or the market seems to be giving it credit for.
The market seems to believe the disinflation will continue. And how do you see the future path of inflation this year to the next year?
Well, I would say over a longer period of time, at least, I think there are some structural reasons why inflation could stay higher. And one of the biggest ones is that in the United States, there's a real reevaluation of globalization. And there's a very big movement to do onshoring or friendshoring, which could be very good for the United States, but it also is more expensive. And so there's very few things in Washington where Republicans and Democrats are in agreement, but the one where there is a strong agreement is that China needs to be watched much more closely, and our trading relationship with China has to be changed. That, in my opinion, is a very, very meaningful change as far as inflation is concerned, and will likely lead to higher inflation in the future.
There are conspiracy theories that the U.S. will keep the interest rate high because interest rate high for a long time in order to shaken up the Chinese economy. If the Chinese economy is weakened, the oil price will also fall. And one of the things that Biden administrations want is a low oil price for the next year's election. Before and there are many this kind of conspiracy theories related to the China in the market. How much of these theories should we believe?
My own opinion is I wouldn't believe that very, very much, especially since, or if it is if that is the plan, I think it's a very misguided plan on the part of the Biden administration. And that's because the U.S. has more oil than it knows what to do with. Unfortunately, the Biden administration is not a fan of the fossil fuel industry, but we could easily flood the system with oil, which would hurt Russia, and which we're sending billions of dollars to the Ukraine to hurt Russia. We could hurt Russia more easily by driving down oil prices, but we're not doing that. So I think that conspiracy theory almost gives the Biden administration too much credit. I'm not sure they're that thoughtful to actually pull off a plan like that.
So you mean U.S. administration, they only focus on their economy, not trying to harm the Chinese economy to...
Not this administration. I think the last administration, the Trump administration, was, I believe, while they had a mutual respect for one another, Trump was very different in terms of his approach towards China. And I don't get much sense now, whether it's Janet Yellen or Gina Raimondo or the president himself, that they really want to pick a fight with China right now. And I think there's a lot of Americans that feel that President Biden is somewhat soft on China. So it's quite the opposite than the last administration.
Do you think there's a high possibility of a government shutdown in coming October?
The head of our Washington office is a fellow by the name of Dan Clifton, and he believes the chances are better than 50-50 that there will be a government shutdown after October 1st. The Republicans believe, especially with the debt downgrade, that there is a need to actually try to rein in spending. And they believe that the political winds are favorable to them. Now, in the final analysis, we'll see whether there's enough courage to pursue that strategy. But as it stands now, it looks like there's a possibility of a government shutdown on October 1st.
This is my last question. Why the U.S. economy is good and the Chinese economy is weak, and what is your outlook for the oil and commodity?
I'm actually pretty bullish on. Well, I'm very bullish on energy stocks, and that's largely because I think that the companies can make a fair amount of money with oil prices in the $75 to $80 a barrel range, and so it might be difficult to get the price of oil up a lot more than that if China remains weak. By the same token, energy demand continues to rise largely because there is still a significant portion of the world that doesn't use any fossil fuels. There's about 1 billion people on Earth that don't have reliable access to electricity. So that provides a kind of an underlying bid for the uses of oil. And I'm not so sure the supply response has been so great that it will hurt the price of oil itself, which is to say that rig count in the U.S. is down. The companies are actually quite conservative in terms of their capital spending. And so anything in this range, it seems to me that oil stocks should do well. The price of oil may be stuck in this range for a while.
One last question. Do you prefer Japanese stock or Chinese stock?
Much more Japanese stocks than Chinese stocks. I sit on a number of investment committees in the U.S. For museums and other philanthropic organizations. There has been a real reevaluation of Chinese stocks and what people own. And I think the damage there has been done, and I'm not sure you're going to see many American investors putting a lot of exposure into Chinese stocks. And that's largely because there are questions about property rights, there are questions about patent rights, human rights. People are genuinely concerned about what it is they really own if they own a Chinese stock. Do you own a claim on real assets, or is the rule of law such that you don't really own much of anything at all? And so I've seen a very big reevaluation of exposure to China these days.
How about the Japanese stock?
Japanese, I think, to the extent to which Japanese growth is surprising to the upside, and then also it looks like the Bank of Japan may abandon yield curve control. Those are things that could be very intriguing for Japan to the extent to which they draw more money back to Japan. So you see more reinvestment, at least among Japanese investors, in their own markets, because Japanese investors largely have been net sellers of both their own stocks and bonds. So those developments could be very interesting for Japan.
Thank you very much for your all insightful and bright and concise answers.